Thank you so much for coming to check out another episode of the Stash Cast, where we have interesting conversations with interesting people. Focused on the world of commercial real estate and prop tech, the Stash Cast is brought to you by Needle. What if you could use data and analytics to predict real estate transactions before they occur? You can with Needle. Come check it out, Needle, NEDL.us, to learn more. All right, today I'm super excited. I've got Andrew Ackerman with us today. He is a founder, a VC. He's got a very dynamic background. And Andrew, thank you so much for joining us.
My pleasure. Thanks for having me.
Yeah. So I was interested to speak with you because of your background and everything that you've done. So maybe if you could set the table for the listeners and tell us who you are and what you do.
Sure. So I have like an 8-second version, and I have like a 3-minute
We
version.
got we got plenty of time.
No worries. So the short version is, I was a consultant when I founded 2 companies, worked in a family office, and for the past 15 or so years, I've been investing in early stage startups, first as an angel, and then as a VC, in an accelerator context, and now sort of as both.
Wow. Okay. So you you said you started as an angel, but then you also are a founder as well, right?
Yeah, so I started off in my career, I was working for a very large consulting company called Booz Allen, which then became Booz and Co. and then became Strategy and, which is probably the worst rebrand ever. Uh, Great way to start, good finishing school for after business school, smart people, but working with like Fortune 100 companies. So, you'd say like, very clear to me, you have to do X. And like 6 months later, somewhere in the organization, they're thinking, oh, X seems like an interesting thing to think about. So really not, it's like more like steering a cruise ship than a speedboat. So I left. I wanted to do something entrepreneurial. At that point in time, like being a startup founder no longer meant you were unemployed. So I ultimately ended up joining a kind of cool startup that we would call SaaS for summer camps, if we were calling that now. Back then, we used SaaS with different terms. I did that for about 8 years, and I was bought out. And then I worked at a family office. So for the kind of the viewers who maybe not quite sure what a family office is, it's basically just a small organization, works directly for a high net worth individual or a family. It could be multi generations of the family on the high end, and helps them invest and in some cases also donate their money to charity. So I got to play around with all sorts of investments. Then I did another startup. Then along the way, I'd started doing some angel investing. And when I was done with my second startup, kind of thinking, do I do another startup or not? I fell into, in a good way, with Dream Adventures, which at the time was not only the third oldest accelerator program in the world, but it was a kind of a pre-seed generalist archetypical accelerator with a VC fund. And from there, we kind of evolved together. And I left in 2020, and I've been doing 6 or 7 of my own things ever since.
That's awesome. So you have a like you came from a corporate background, and I feel like that as I'm thinking about the other conversations I've had or will be having, that's kind of the theme is that people start in a large corporation because maybe that's the dream or that's the dream that's sold to us, right? As kids coming up through school, go to college, get a good job, and then go get hired by a big company. But then it seems like a lot of people, like in my world, in commercial real estate, a lot of people start maybe with a sales job or, they start as an analyst for somebody else and then they evolve into the ownership side of things. It sounds like you kind of did the same thing as well.
Yeah, so I think, when we do these kind of things, it's a bit of a biased sample. So first of
Sure.
all,
Yeah.
like, you know, don't let my boyish demeanor mislead you. I'm a lot older than I look, which I much prefer to the alternative.
You and me both.
So when I came out of business school, I went to Chicago Booth before it was even called Booth. There was really only 2 doors on the way out. It's like, iBanking on that side and consulting on that side. Like VC, I had one guy that I knew in business school went to VC, and nobody quite knew what Ben was doing. Ironically, now Ben and I are tight. Like we talk all the time. I know exactly what he does, but like at that point, I'm like, yeah, I don't get it. And since it was, Chicago Booth, if you were like in marketing or something, people just looked at you like you're in the wrong place.
Right.
But the idea of like going into VC or going into the startup world, like that didn't really exist when I came out. So in part, people you're talking to tend to be a little older. They were probably still riding that era or the tail end of that era. It really wasn't until around 2000 where, certainly on the East Coast, the idea that you're, going into entrepreneurship, like that's a thing. And that's a thing that they actually would teach you to do in business school. They started to bring up curriculum for that. So I think, in that regard, you're also going to, start seeing the origin story of the people you interview shift over time. Now, looking specifically at prop tech and construction tech, um, these industries aren't really very forgiving of outsiders.
Yeah.
If you come in there and you're like, oh, I did a great vertical SaaS in restaurants, now I'm going to do it in real estate, you know, customers and investors will be like, that's cute. You don't know which way is up. So particularly with our industry, domain knowledge is critical. So the people who actually manage to succeed at all, as an entrepreneur or as an investor, need that street cred. Now I'm a bit of an anomaly. I actually didn't do anything in real estate prior to getting into investing in real estate. I was at the only family office probably that didn't do real estate deals because my principal, the boss, the high net worth individual, was not a U.S. citizen and didn't want any effectively connected income for tax purposes.
Oh, okay.
So I made like a double anomaly, but I kind of snuck in through the back door because I'd been doing venture for a long time. I'd been doing venture in an accelerator context for a long time. And when we decided, that is when Dream had decided to spin up what we call the Urban Tech program, prop tech and construction tech, it was early enough that, you could kind of go in there and get in on the ground floor. So I came in with the investment background and I picked up the real estate construction tech. I think it would be a lot harder to do that now.
Yeah, real estate is, and I think construction probably as well, are very relationship based and focused. Commercial real estate in particular. Um, yeah,
I'll add to that if you don't mind.
please. Yeah.
It's not just the relationships, which that's a big deal. Like your initial investors, your initial customers are going to come from there. But it's also like it's actually a really complicated industry with a lot of broken down players. Right? So what I mean by that is, like, if I'm going to do build a new building, right? Developer, general contractor, architect, um, property manager, brokers, agents, leasing office, whatever you want to call them. But there's at least 5 actors involved, all of whom have their own incentives and their own business model.
Well,
Right?
lenders in there as well.
And the lenders, yeah, I lend
Yeah.
money too. So, and it's, depending on, title, you want to throw other people in there.
Yeah.
There's a lot of different people with different incentives and different backgrounds that come together in our field. It's not kind of like manufacturing where everything that comes into the door, I bought, everything that's leaving the door, I sell, and everything that happens inside my plant, I own and I hire.
Right.
Right. That's a simpler industry structurally. So there's a lot of shibboleths, right? To understand, like, if somebody comes in there and gets NOI wrong, right? It doesn't, like, that's it. No street cred anymore, right?
Right.
If they don't know what a BIM is, no street cred. You're out. We're not talking to you.
Yeah.
So it's a little bit of that too.
So how did you, given your background in the other areas, how were you able to get up to speed and then earn that street cred?
For the first year as I came in, I smiled knowingly a lot and then Googled.
Yeah.
Yeah, but I mean, I'm joking a little bit. I came in with enough humility, right? And I always said, like, listen, I'm surrounding myself with people. So when we did our first cohort, an accelerator cohort, and we were focused on, prop tech and construction tech, I had at the table with me for the interviews 20 people who were in like top firms. Right?
Mm-hmm.
Guys from CBRE, I had guys from Skanska and Suffolk, you name it. I have their chief innovation officer or the equivalent in the room interviewing the startups with me. And I wasn't, I was fortunately confident enough at that point in my career that I was happy not saying things for big
Yeah.
chunks of the time.
Well, it's almost like you can learn through osmosis in that way too.
Yeah, yeah. And then that's ultimately how I came up to speed on it. And the truth is, if you've done a couple of different industries, it's like learning languages. Like after in the
Yeah.
first one or two, well, the first one you're a kid, but like the first foreign one you learn, like it's hard. But once you start doing it, like picking up new languages, so I'm told, becomes easier. It's like I launched EdTech before this. I was a generalist even before that. The fund I was with at the time did a lot of health tech, so I was reasonably fluent in health tech. So, you kind of get the patterns, right? You kind of get a sense of like, oh, this is actually where the hard stuff is.
Hmm.
I'll tell you actually a funny story.
Yeah.
I did this in ed tech when I first kicked it off, and I did it again in urban tech. I just wanted to get a sense of where the interest was in the venture scene, right? Because there's some ideas you look at, and like when you're a generalist, you're like, oh, that seems really cool. And then you realize, oh, that's like a 5-year-old idea that everyone's moved on from. When you're a domain specialist, like you get that, right? You understand exactly where like the thin end of the ice is, where it's like safe to go up to, but not beyond. And before that, you're like, oh yeah, we've all done that already. So I started writing articles, which, I like would jokingly call like stale startup ideas that make me throw up in my mouth. I was very lucky about getting stuff in print. Usually they would like change the titles, but I sent
Parse
it
it
out to
down.
people. I would send it out to like, my newfound friends in the industry, and the VC in the world. And I'd say like, hey, I'm starting to see like these ideas and like, I keep getting pitched like A and B. I think it'd be funny to do an article about like, don't pitch me this crap anymore. What are the ideas that like, you're just tired of seeing again? And like, people loved it. They're like, oh, I hate this one. I hate that one. I copy, paste, kind of do a quick edit. So it was in my own voice and like the articles were written. And at the same time, I'm like, oh, I guess that was 5 years old. No problem. So it was a good way to like little hacks like that were a good way to get up to speed.
That's great. So I'm curious, what were some of the things at the time that people were like, I don't want to hear this anymore?
Oh, God, I got to remember. I can dig up the article for you, but like, I'll give you like an example. Like if you're talking to people now, they'd be like, "Oh, it's another tokenized real estate play." Ah, not again. In fact, even back then it was a little old. I remember I was at one pitch event and they were like 10-minute pitches, which is like long. And all of a sudden, like the slide comes up and it goes, fractionalized real estate ownership for the masses. And I turned to the person next to me like, it's gonna be a long 10 minutes.
Yeah. Yeah, that it's an interesting concept, but um it does seem like there's a lot of folks out there trying to do the same
Yeah.
thing.
And they have been trying for like 5 or 10 years. And I tell people like, you're a little late for that party. And this goes back to like what VCs you look for in a way, right? The overarching thing for what a VC look for, we'll say we're looking at markets, et cetera, but we're looking at the top level at why now?
Hmm.
Why is this something that couldn't be done before, now can be done? Because if it could have been done before, there are hundreds, if not thousands, of people who are trying it, right? You've
Yeah.
got hundreds of thousands of really hungry entrepreneurs, smart entrepreneurs, people who are in the industry, have left the industry. They know that they know what the problems are. So when something becomes possible, like when AI is suddenly available for the masses, when image recognition becomes good enough, or speech recognition, natural language processing, like these are all just examples of technical breakthroughs. But when these things become possible, a bunch of people are going to come up with similar ideas
Hmm.
because they know the problems. Like, oh, I can use this for that. And of course, then when they pitch me and I tell them I've seen 5 of them this week, they're like, oh, they must have stolen my idea. They didn't steal your idea.
Yeah.
But it's like parallel evolution.
Yeah.
So if that becomes like, I also tech, it could be a regulatory change, it could be other things. But if there is an event,
Right. Like when crowdfunding platforms exploded.
bingo, like crowdfunding, it could also be like,
Because I had that idea too. I was like, this is going to be great. We can use the internet to raise all this money.
I was like, oh, we should do porn on the internet. I'm like, okay, yeah, you're about 40 years too late for that.
Right.
Um, but or it could be like Sarbanes Oxley. All of a sudden now you've got SOX compliance, right?
Yeah.
So whether it's, you got to point to something, usually something pretty dramatic, regulatory tech, it's usually something like that. But there are other exceptions. It could be cultural. Like Airbnb was a cultural shift. Could have been done 5 years prior, but like the idea, like, oh, we'll share, like that was pretty out there. But if that why now moment happened 5 years ago, there's a lot of people bouncing against it. So if I get a pitch that could have been done 5 years ago, my immediate move is I got to go see all the competitors, right? And what's not only the competitors, but the people who are now dead, right? So it could be that there's someone out there and already 5 years ahead of this new guy, in which case, good luck with that, right? You're late to the party.
Mhm.
Or if there's no one doing it, but they could have been doing it for 5 years or more, odds are there's something fundamentally wrong with the idea. Like it seems plausible, but people just don't want it. Right. So if you're coming to a VC with an idea that could have been done 5 years ago, the argument you're trying to make is everybody who has tried this before has done it wrong. And I know why each one of them failed. And I can prove to you that I am doing something meaningfully and, quantum level different and better than what they did. And that's a very hard case to make, which is
Sure.
why if there's no good why now, it's usually a pass for VC.
So how do you find those carcasses of failed um, competitors?
So back in the day, I used to recommend AngelList because people put
Oh,
their companies up and they never take it down. Now AngelList has changed their interface like 17 zillion times, so you can't really use that. But you can look at like Crunchbase and all those other PitchBook. Look for companies that have similar ideas, so when they were funded, and then you look if they haven't raised money in 2 years. There's a good chance they're the Walking Dead. Then you can go back and look on LinkedIn and see what the founder's doing. And if they have a different job, then that's like a giveaway.
yeah.
And by the way, if you're thinking about something and you find a couple of companies like that, reach out to those founders.
Yeah.
I reach out to them and say, hey, why didn't it work, Stash?
Hmm.
Um, so you can find them that way. Google searches work also because sometimes like the web pages don't come down that quickly. Uh, yeah,
Well, it's the remnants of failure. No, once you kind of close the book on it, you kind of don't want to go back and, and revisit it.
yes. I mean, some people will take, they'll stop paying their their GoDaddy account. It comes
Sure.
down.
Yeah.
You could also use the Wayback Machine, right? So if you find out a name of a company, but like the page isn't up, there's the Internet Archive. I think it's archive.org. Just Google Wayback Machine. They cache old web pages. So you
Ah,
can go to the Wayback Machine, type in the URL of the company that you were trying to research, but now their website's down, and you can go back and you can see like snapshots of their website going back as far as the Internet Archive has for them.
yeah. Wow. That's amazing. Um, I'm curious, I guess, as a founder, what are some of the early lessons that you learned? I'll have a couple of questions. I want to hear about like your experience as a founder. I want to hear about your thoughts on, you know, why, and you touched on it a little bit, but why um, real estate and commercial real estate has been so slow to adopt technology.
Mhm.
I also want to hear because I'm coming at this from a different perspective. I'm a commercial real estate broker by trade currently, presently, and we built this solution to help brokers, go out and find more deals, and then acquisition people and asset managers and loan brokers. So like I'm the ideal customer profile. Um, so, the startup and VC space, I have a degree in psychology. And then you can say I have a master's in real estate just by being a broker for 15
Mhm.
years. So I guess those three things. What were your lessons as a founder? Um, you know, you touched on a little bit, but why do you think commercial real estate has been so slow to adopt new technology? And then, what is the role of a VC? Because when I first thought of it, I was like, oh, they just give you money and let you run. But the more I'm learning, it's like, no, you really want to find the right partner to help you accelerate your growth.
Sure. So why don't we take those one at a time?
Yeah.
And I'm notorious for like after I answer the first two, not remembering the third. So you may have to prompt me on that.
Okay.
So your first question was, what are some early startup lessons?
Yeah.
Um, I'm going to start with a book that I hated. I hated Anna Karenina. If you've ever read it, Leo Tolstoy, it's like that thick. It's kind of like a soap opera, but it has, to my mind, the best opening line in any book. I'm not going to do it in the original Russian because I don't know it, but it translates roughly as every happy family is the same. Every unhappy family is unhappy in its own unique way.
Yeah.
So the reason I like that is that that's about startups, right? Every successful startup is in some ways the same because they've navigated all the pitfalls well enough, nothing killed them, and they kept going. Right. So they have a certain sameness to them in that they've checked all those boxes. They've learned all the same things.
They've figured
Now,
it out.
the ones that fail tend to fail in their own unique, spectacular way. Uh,
Hmm.
and so the failures are sometimes a little bit more fun to talk about. But I'll give you one personal example, right? This could be like 3 hours in and of itself. So when I did my first startup, it was a company called Bunk One. We did SaaS services for summer camp. So we started off with like photo galleries and what we called one-way email systems. The ability to send a note to your kid, just print it out and hand it to them. So they don't have to be anywhere near a computer. And mobile phones didn't exist back then. So actually, smartphones didn't exist back then. So we did that. And I had come out of like a large consulting firm, and like the salespeople were going out there and they were saying, oh, $599, $899, $698. And like there were all these plans, they were fundamentally not that different. And it was driving me nuts. I had this long spreadsheet. I had to go figure out like who was being charged what. And
Oh, I see.
at one point I started like being pushed back, like, can't we just standardize? Like, can we do X, we do Y, like these three plans. I was kind of pushing hard. I was being a little bit like annoying about it. So the CEO, I was a COO, so that was kind of my job. My CEO pulls me aside and he says, like, listen, you got to stop with it. We're a startup. At this stage in our growth, we just need to say yes, right? If the customer wants it to be $5.98 per person, just say yes, right? Once we have them for it and they're happy, then we can say, hey, bud, can we put that to $5.99 like the other 12 plans we have? So at some point when you're early on in your evolution, you just have to say yes and run with it because you need the experience with real live customers and the actual revenue more than you need any kind of simplicity in your life or standardization. But as you start growing and emerging, and you've kind of got the product market fit, you've got the feedback from your customers, you know what they want, what they don't want. Then there's a time, and we did at that point go back and try to kind of rationalize the different offerings. There's a time for them to try to standardize because it's easier to learn at that point what works, what's optimal, what isn't. So then we went back and we would optimize things like it was the end of the camp season, and now we want to sell like the photos that were taken during the summer. We know that once the kids are back, like parents are like, okay, we got what we wanted. So we would optimize those end of season, ads, different pricing, different coupons. So there was a time to do that, but there's a time to be flexible and just say yes, and there's a time to start kind of standardizing and figuring out what works, and that goes across the entire organization, from pricing to your sales pitch, right? How if you're in commercial real estate or if you're a SaaS startup in general, like how do you go from like just being the founder pitching and like winging it and seeing what works? So I have to hire 5 people to be salespeople. I need to give them a script. I need to give them a process. I need to tell them how to qualify. Right. So as you grow and emerge, you will then start to put more and more structure around it as you grow. But getting the right level of flexibility to structure at the stage in your company is critical.
Yeah. I'm kind of, so I've got a partner in this, and I've got two partners actually, but one operating partner, and he's very, let's get it all perfect before we get it out there, and it's great for the solution. But when we're thinking about sales process and pricing and all that, it's like, I don't know, we're just going to figure it out. And he doesn't like that answer, but that's kind of what I'm hearing you say.
There is no perfect, right? I mean, there are companies like Gmail has been around for how long? It's still in beta, technically, I think. I don't know if they've changed that yet,
Yeah.
or it was for some absurd period of time. So I was that guy. I'll give you a little bit of free advice for that guy. Instead of saying perfect, you're like, hey, we don't know what perfect is. Like we're all in a bubble here trying to decide what perfect is. You know, the goal really, if you want to have something that we can actually quantify, because I'm guessing like that's kind of where he likes to go,
Yeah.
is what works the best, right? So let's agree on a metric, right? To quote one of my former bosses, Steve Barr, she's like, "This is a success if," right? Let's figure what that out, what that is, and then let's run tests, right?
Mhm.
If you're kind of B2C and you do a lot of email marketing, you can A/B test subject lines, right? If you're business to business and you're doing sales, you can kind of A/B test strips. Like we used to A/B test, do we offer the photo gallery first or the email system first? And we didn't do it super structured and kind of like, hey, you're going to try this, try that, but think about who's leaning forward and who isn't. But you can quantify that. You can get to the point where instead of him thinking, oh, I want to get it perfect before I ship, it's like I want to design a good test that I can ship quickly and figure out which way I want to go. Uh, anyway, I find that sometimes transforms the like, I want to push now, I want to wait and get it perfect into like, no, we both want to push quick and launch the perfect test.
Yeah. No, that's good advice. And I think you would bite on that too. So
Let me know if it works.
I will. I'll keep you posted. So the next part of the three-part question was, in your experience, why do you think that, and I'm focused on commercial real estate, but you could probably lump construction in there as well. Why do you think they've been so slow to adopt or adapt to new technologies?
So, the answer a lot of people are like, oh, they're old white guys and they're set in their way. Um, I'm not going to say that's not true to an extent. Um, it's also like too easy. Like
Yeah.
every industry, the people who are in charge historically have been old white guys, right? And
Hmm.
that's changing over time, but other industries have managed to adopt tech, right? So they get there. And by the way, like until recently, John Gilbert was like the COO of Ruby, and he was one of the most tech forward, savvy adopters of innovation that I knew. So shout out to him, as old white guy as it gets. So that's too easy an answer. We talked a moment ago about the structural issues, right? So in other industries, generally there's more unity of actor, like the people who make the decision are the same as the people who benefit and are the same as the people who pay. Right? Now, that's not necessarily the case in some industries, right? I mean, if I am a developer and I'm hiring a general contractor, like I would benefit from the project being done faster. GC does not necessarily, not to the same extent.
Right.
Or to take just a different
Their
industry, like
incentives
project,
aren't aligned.
yeah. And the same with the architect, right? Like, his incentives are different from the GC and his incentives are different from, the developer and so on, all the way down the line. But I'll give you an example in a different industry that is probably the most extreme example of it. So in the healthcare industry,
Hmm.
you've got a patient, a doctor, and an insurer, right? Patient benefits, right? The doctor basically makes the decision what kind of treatment with the patient's input, but the patient doesn't know anything, so they follow the doctor's advice a lot of the time. But the insurer pays,
Right.
and think about how screwed up that industry is. Right. So we've got a good chunk of that in the prop tech world as well. So again, I'll bleed back into advice for founders out there. Just keep in mind those three questions: who benefits, who pays, and who makes that decision. And make sure that you have pitched not only your idea, but how you price it and who pays for it, and all that kind of not so fun stuff. in a way that you've threaded that needle. So, for example, a lot of the stuff that uh, that you're pitching to, say, a property manager that make the building total cost of ownership of a building go down don't actually benefit them. So you want them to make the decision, but they don't make any money off of it. Who's going to pay for it? So they have to go back and they have to get the property owner to like basically permit them to do that. So maybe you should just be selling to the property owners to begin with. Or maybe if you're an early stage startup, your initial core target are only the owner managers. Right? They're your initial market because they're the same person. So now
That's
you've
the
got
least path of resistance.
yeah, and you kind of work your way out. So there are other examples like in some cases you might want to pitch only to design build general contractors because their architecture is in-house. Like that might be a good initial path to market as you start building the benefit case up so it's strong enough that you can go to it where you got two separate actors and make them both get aligned. So that's probably the single biggest issue in our industry, and it's tough. There are ways around it, but it's still tough.
Yeah, and may I articulate my thoughts on why it's been
You own the mic,
slow?
go for it.
I do, yeah. But so in my experience, so when I first got started, I got my first job in real estate in Santa Barbara, California. It was great,
Lovely.
beautiful place. But there was one brokerage firm that like owned the market, and they specifically would not subscribe to CoStar, um, a big data provider to share comp information. And they did that to, protect their moat. And, I think that that has been, in my experience, has been that the owners and operators from, um, I'm 41. So the guys that are like 20 years older than me, they tend to have that, no, mine. This is,
Mhm.
sort of mindset until you earn in with them, and you prove that you're trustworthy and such. But the guys that are younger that are coming up, they're much more, you have these mastermind groups and you have, hey, let's get together and share ideas. And um, the protect the secrets at all costs, I think, is phasing out. And just because technology is marching on, whether they like it or not, you know.
So
Uh,
I'll build on that if you like, right? So that's
please.
definitely the truth, but you do get that dynamic in other industries too. So usually where it's better or worse is how concentrated the industry is. And real estate and certainly construction is not hyper concentrated. So in theory, like the less concentrated you are, the less like, oh, my moat matters should be an issue. You'll get uh, you'll get local differences, right? Like if I own 80% of this market, like that's my data. I give it to CoStar. Like I'm not learning that much more than I would have learned. Everyone else
Right.
is learning a lot. So you will get on the local level some of that dynamic. And different for commercial brokers versus residential brokers. It might be different for developers versus property managers versus brokerages. But overall, as an industry dynamic, it's not particularly worse than other industries I've been in. Um, but it may in connection with some of the other stuff, right? So if I'm like, this is my advantage. And when you're pitching them something, it's like unclear, I benefit, who pays, I pay, they benefit, right? Again, like in your example, that brokerage, like, well, I can pay by giving my data, but those other people are my competitors benefit.
Right.
So I don't think that in and of itself is unique uh to real estate. Uh yeah, my 2 cents.
Yeah. It's interesting to say the least. Um, let's shift a little bit. I'm curious to hear, I want to learn more about venture capitalists and, what
Sure.
they bring to the table and, deal structures and things that you like we're trying to apply to um an angel group, and we keep getting shut down because they don't like safe notes, for instance. And it's like, we're flexible on that. We don't have that many out there. We can convert them. Like, just help me help you. Help me help
Sure.
you help me.
So let's break that up into a bunch of pieces here. But before I begin, um, how do I have to censor myself? Where are we language wise? Are we like
I don't
our
care.
kids watching this?
No.
Oh, okay. So like VCs are fucking hypocrites. Uh, so here's the deal, right? So I would go to you, Stash, and you're pitching me whatever your idea is. And I'm like, well, Stash, no, your idea has to be a quantum level better and visibly and obviously different than the competition. It kind of looks like you're, same, a little bit better, maybe a little worse. And we don't invest in like marginally better. We only invest in like great leaps forward, right? Okay, that's kind of reasonable. But then you look at a VC's website and they're all the exact same thing. It's like, we're two or three really smart guys, non-gender specific guys now, hopefully.
Sure.
Maybe we're exited founders, maybe we have decades of experience in the industry, maybe both. We're super connected. We can give you great advice. We can make great introductions to potential customers. You should really take our money, which is exactly the same as every other VC out there, just with a different logo. We're not eating our own dog food there. So I've always been a huge fan of platform-based investing, which means that you're actually doing something unique and different. So I'll give you an example. Right. So Dream was, I think I mentioned, one of the earliest accelerators in the world. But it was at one point, everyone had copied that model. Early, sit your butt in a chair, 10 to 12 companies, 3 or 4 people per company, speakers, pizza, beer, and then demo day at the end, pitch your heart out. Weren't differentiated anymore. Like we then realized that, we were that guy. So we decided, like, well, what do we need to do to actually be legit different? So I ended up going later stage, post-revenue pre-Series A. And then we had to change everything about the model and the offer. But what we ultimately settled on, what I built to a large extent when I was there, it's mainly the reason I stayed as long as I did, was we built a program that was structured around customer sprints and investor sprints, 2 weeks of each. So the customer sprint was, like, now we're vertically focused. I have over 100 different potential customer partners in our network, developers, property managers, brokerages, architect firms, GCs. You, startup ABC, come into our program. We have 2 weeks of sprints. These 100 partners will choose who they want to meet with. And we usually generate between a dozen or 2 dozen plus meetings within those 2 week periods. And those are qualified leads because it's not just in the room in front of everybody. It's the people who said, I like those 2 startups. I want to meet with them. So, on the one hand, you have a VC fund. Oh, we'll make really quality introductions for you. On the other hand, what Dream was like, we'll give you up to 2 dozen or more introductions face to face to qualified leads in a 2 week period. Well, okay, that's a quantum level better, visibly and obviously different. And on the flip side, with the investor showcase, it's like, hey, we don't do demo day anymore. Instead, we send the companies out, and the VCs that are interested tell us who they want, and we'll sit you down face-to-face meetings, a dozen, 2 dozen or more, with the VCs who have said, we like what they're doing, we want to talk to them. Okay, demo day, room with a couple hundred people, many of whom might just be service providers, versus 2 dozen face-to-face, one-on-one meetings in 2 weeks. And by the way, they're Series A check writers, not seed. That's visibly and obviously different. So that's what I mean by VCs need to eat their own dog food on this. And there's a bunch of different ways to do it. I actually posted an article on LinkedIn, I want to say 7, 8 months ago, about some different platforms that I've seen that are actually meaningfully different for VCs. So I would say, from your perspective, Stash, if you're going out there and you're raising money, and if you have the choice, like, you would start with a VC that's got some kind of platform that's more than just, hey, we're sharp guys and we can give you good advice and make intros. So that's one part of your question. You also mentioned stuff like, this angel group won't talk to us because they don't like safe notes. Like, there's always going to be someone that has some weird, like, I don't like this, I don't like price rounds. Like, I don't know. I think God created convertible notes and safes so that, well, actually, God just created convertible notes. YC created safes. But it's just to avoid this whole like let's fight over the valuation.
Yeah.
I don't care one way or the other. Different investors will have different preferences, and your answer correctly is no problem, right?
Okay. Yeah.
We'll raise on a price round. And if the price round is over usually $1 million, any notes that we had are safes, we'll convert. And here's what our cap table looks like afterwards, right? It's not that difficult. I will say one thing that if you're a startup, don't go in there on your ask and say, oh, I'm raising X on a safe with this post money cap, or I'm raising Y with this valuation. You don't set your terms unless you already have a lead, in which case that's, you have a lead, we've signed with them, then you do. But as a startup, you receive bids, right? The investors that come to you will, with some exceptions, say, Stash, I like what you're doing. Here's my term sheet. I'll invest $2 million on an $8 million pre. And then you can decide if you want it or not. And if you want to actually like have any leverage in the process, you want to structure your fundraising process so you get term sheets from multiple players at the same time.
Yeah.
Now you may not, like some startups get 0, so you're happy to get 1. But if you ideally work it right, you got 2 or 3 term sheets, you can choose for whatever the best deal is. And deal is not just valuation. This is a better fund because they have more that they can do for me, even if the valuation is lower.
Yeah.
This one has some weird participating preferred clause, so even though their valuations are higher, I don't want to deal with them.
It's
But
just like a
you get
brokerage
leverage
deal.
by getting multiple interested parties in you, and
Yeah.
they will tell you what the terms are, and then you can go back to them and say, I really love you, and I love you more than anybody else. But this other guy who's not quite as hot as you offered me better terms. Can you match them so it's an easy decision for me?
I'm getting goosebumps right now because you're describing how we run our brokerage deals. You run a best and final. The it's
That's interesting. It is kind of like I need to go to best and final offer now.
yeah.
It is kind of like that. I've got one. I have a week before I need to sign it, right? I have to go accept this or not. Give me your best and final. But you phrase it a little different with VCs because you have fragile egos.
Um, one of my biggest challenges though has been finding, prop tech focused VCs that are interested in what we're doing. Maybe it's just the climate right now, but what are your thoughts or advice on
The
that?
climate is tough now.
Yeah.
Like there's no fun in fundraising, even in the best of times.
Yeah.
But there's a process, right? So I give this presentation. I give this presentation for a lot of VCs, accelerator programs, universities. How to prospect for investors. We haven't actually talked about this, Stash. I've even written a whole book, which I have a publisher for, which talks about the startup journey in a novel format. So it's actually less dry and boring than most business books, but it goes through like the entire process. The key thing that a lot of startups fail at is they don't start with 50 to 100 relevant prospects. Because that's what you really need to do. That when some people don't answer you, some people you can't get warm intros to. This, by the way, is a funnel. It's a sales funnel.
Yeah.
Well, some people drop out because you can't get the warm intros or they don't care. Other people like you start talking to and like, I'm not that interested in it, or I have a portfolio conflict. Couple go and they start diving deep into it. Some of them fall out because they find something they don't like. And at the very bottom of the funnel, you want a couple of term sheets to fall out. But if you don't start with 50 or 100 and you don't do it at the right time, like not a little bit at a time, but like try to get them all to come to a boil at once, you don't end up with that sweet spot where you actually have a couple of term sheets to play off each other, right? So that's the key mistake. Now, a lot of them come back to me and say, well, how do I get to 50 to 100? Like, I don't know. Like, how many do you know? I hate that question, by the way. Right? Who do you know that I might be interested? My mind is not a SQL query, right? I don't know how to say, oh, I have all the inputs about what you do. Here are all the investors that I know. Here are the matches. Like, my mind doesn't work that way. I'll give you like 3 or 4 that just jump to mind. But the right way to do it is to come to me or someone like me and say, hey, here are 5 investors that look like they're good fits. It looks like you're connected to them and you're linked to them on LinkedIn. what do you think? And a yes, no, like, oh, they're a good fit for you, or no, they're out of money, or no, I know they invested in a competitor. Like I can do yes, nos if you give me that. I can do that all day long. So the key when you raise money is to get to that prospect list first, and then find where you can get those warm intros, and you ask people, like, are they the right person? And then you can ask, and by the way, is there anyone I didn't tell you? It's not on this
Right.
list. And then you might get one or two more. Now, to preempt your next question, how do you get to that list with 50 to 100? I'm trying to condense like an hour presentation. I'll give you an example. Go on Crunchbase. Find one or two companies that you think are similar enough to you that the people that invested in them would be interested in what you do. And not like directly competitive for the obvious reasons. And if you're not sure if similar or not, what that means, think about this. You're going to ask me for an intro to somebody. You want to be able to say, Andrew, you know John Hellman, RETB. He's invested in A, B, and C. You know that the company I'm doing is this. I think he'd be interested. Can you make that intro? Right. So if you can finish that sentence, A, B, and C make sense, then you're similar enough. So for instance, it might be another prop tech company that services commercial real estate brokers. But let's say you're creating a marketplace for them. I don't know, that's not what you're doing, but let's say it's a marketplace for real estate brokers to find, I don't know, contractors that do build outs, right? I made that up.
Sure. Yeah.
You might say, oh, well, I'm like any other SMB to SMB marketplace. Well, this investor invested in an SMB to SMB marketplace in catering. Maybe they're interested in mine. It's not real estate, but they know what it's like to connect small businesses. So that might work too. So kind of cast that net a little broad, because you might actually be playing in 2 or 3 different pools. So as you start with a couple of companies that are sort of similar in each one of those pools, then you go look at who invested in them at the stage that you're raising. Right? So if you're raising a seed, you look at the seed stage investors. If you're investing in raising an A round, you look at who their A round investors are. Write them down. And then you go and look up those investors and see what else they invested in. And some of them, if they're generous, like, well, that's not relevant to me at all, right? That's like Uber. I'm not doing anything like Uber. But you might come up with another couple of companies, and you're like, oh, they're kind of like me too. Okay, then take it, write it down on the other side of the piece of paper. And then you look into see who invested in those guys. So you iterate back and forth until you have a long list of investors who are potentially interested. And by the way, you also know for each one of those investors which A, B, and C they invested in that makes you relevant to them.
That makes a ton of sense.
It only took me 20 years to figure that
out. Well, that's what, honestly, this is part of the reason I'm doing the podcast, is to have conversations like this with guys like yourself, and, try and, shortcut that bang your head against the wall process that otherwise is out there. You mentioned something earlier, though, about not setting your terms, and I hear you. I get that. But how do you do that? Because
how do you not set your terms?
Yeah.
Oh, here's your ask slide in your deck or your verbal, right? We are raising, how much are you raising, Stash?
2 million.
2 million. Can I ask you, like, in a year and a half with that 2 million, what do you expect your revenue to be if all goes well?
I think so. For 25, we're targeting only like 250 licenses, and then I think maybe like 750 the next year. So revenue on 299. I don't know. I don't have it off the top of my head, but we've got it all mapped out.
Just make up a number, right?
Yeah. So if, revenue in year 1 is, call it 100,000, we're targeting maybe 350 to 500 in year 2.
So then you would say, listen, so Andrew, I'm raising $2 million to get to 250 licenses and totally forgot what you said, $500,000 ARR by the end of 2025. That's it. And on the bottom, underneath it, you might have your use of funds. And to do that, I'm going to be spending, 700,000 on hiring new engineers and, another 250 on hiring another salesperson and, whatever, rent, whatever you're spending the rest of the money on. But the key headline is, an investor, I want to know, like, I'm buying a piece of your company. What am I getting in return? I'm
Mhm.
not getting the fact that you're hiring engineers. That's how you get what you need to give me back. What I'm getting from you is a company that's performing at a certain level by a certain period of time. That's it. That's your pitch. Now, if a VC comes back to you and says, "So Stash, okay, if you're raising 2 million, what do you think? What are you thinking about valuation wise?" Right? That's a question on our part to make sure that you have reasonable expectations. So you should be talking to, a couple of your peers and saying, what do you think is reasonable at this stage? So you might be able to go back to them and say, well, listen, we're going to let the market determine it, right? Let the market determine it. But we think that if we raise on a safe, for example, we may be coming out anywhere between, a $6 and a $9 million post money cap. Right, so that's your way of telegraphing to me, hey, I know how the game's played, right? I know I don't have leverage here, but I also know roughly where the market is. And then I can come back and say, I don't know, I think like you may be overestimating. I think in this market, you're only going to get a $5 million post. And then you can decide, well, we'll see. Let's, if you're interested in a $5 million post, we're not ruling anything out. Or you could say, screw that, that's way too much, or too little. But you can say, we're not ruling anything out. If you're interested, we'll consider it.
Well, and then the discussion, it seems to me, is okay. Well, if that's your value, what are you bringing to the table to help accelerate this? And
You mean
that,
as a VC?
yeah, to
Yeah,
help
that's a
value add
totally
the deal.
reasonable question, but don't ask it.
No,
Not yet.
you're right.
Not
Right.
yet. That's like,
Right.
how many kids do you want? Like, lady, this is our first date. And also, by the way, you should know some of that by researching me in advance.
Yeah.
Because if I do have a unique platform, I'm not going to be shy about it. Like, I'm not keeping that under wrap. It's a
Sure.
lot of work to
Yeah.
create a platform. By the way,
Well,
it's not enough to say, oh, I have a platform, like, figure out what that means, right? So you can do a lot of your own homework, and you should, and you absolutely must do all your homework beforehand. But for that first meeting, it's really just like, hey, you're cute. You're not an axe murderer. I'm okay for a second date.
yeah.
So really, like, first one is just make them fall in love with your idea. Get a rough idea that you're in the same ballpark, right? If they do ask, you could say like, hey, for a company like mine, you could turn it around. If I asked you, what do you think the valuation is, and you're really not sure, you can turn around and say, well, listen, we're going to let the market speak, right? It's our first time doing it, or, you know, we're kind of in an interesting space. The market's in a weird place right now. If you were interested in a company like ours, where do you think our valuation would come in? And then I might turn around and say, oh, boom, like this, and I might lowball you a little bit. And then your response, whatever I say, would be, it's a little on the low side, but we would consider it, right? Which is my
That's
way of,
great.
I'll
Yeah.
know what you mean, you'll know what I mean.
Yeah.
But it's a little bit of playing the game. But then, like, once you've established a relationship, and I've told you I'm interested enough, and I want to look at your model, and I'm starting to dig in, you can start gently asking, well, okay, listen, like, you have a great reputation as a fund, true or not. How do you normally add the most value to your startups? Like, can you give me some examples of, like, life-changing moves that you've done to a startup, put them past an inflection point, and ask gently, because we have fragile egos. You can ask and drill a little harder if you actually have other term sheets in hand. So, like, hey, I just want, I'm talking with another company. Don't give me their name, by the way, until you've signed. Right? I'm talking with another company. So, who are you talking to? Like, well, I haven't signed the term sheet yet, so I'm not comfortable disclosing. The reason I say that is, like, if you tell me you've got a term sheet you haven't signed from somebody else, I'm gonna pick up the phone. I'm like, hey, I heard you gave Stash a term sheet. What are you offering?
Right.
And we might kind of collude on price, and I won't bid it up. But you might say, hey, I'm talking to like an interesting fund out there. They've got like a unique platform. They say they can do X, Y, Z. Be careful, because if X, Y, Z is very, very, very unique, I'll know exactly who you're talking about. You can try to get a sense of, like, how specific is it, And if I do have a platform, you can ask me metrics. I said, oh, we do these 2 weeks of customer sprints. Like, oh, on average, how many meetings with customers do your portfolio companies get? Ask me. I should have them.
Right.
But I would save that for second and third dates.
Right. Yeah. Because yeah, you don't want to just hop in and say, "Hey, we can do this or not." On the first one, you gotta kind of feel each other out. As you're speaking, it is so much like brokerage. The analogies that you're giving me, it's the same as brokerage.
Yeah, a good 80% of the time, the analogy will work. You just need to be very cautious about the 20% of the time where it will utterly break out and like break down, and it's a different dynamic. That's the problem with analogies or mental templates. But there is a lot of similarity.
Mm-hmm. Interesting. Um, what when you're when you're investing in companies, what do you look for in startups or founders or the solution, things like that?
Got it. So we've already talked about like the overarching question, which is why now? And I often don't ask that because I sometimes know, right? It's obvious. But if I don't see it, I will ask that explicitly. Beyond that, in the company, all the usual things, right? So um, startups like a chain, like a chain. It's not like a rope. And the reason I say that is a rope, if a couple of strands are frayed or broken, the rope will still hold. But a chain, if even one link is busted, chain's useless. So
Yeah.
that means if you have a startup, you have to have every single page in your deck, right, which represents every single link in the chain has to be relatively solid. So the problem has to be painful, frequent, and widespread. Your solution has to be a quantum level better than what's out there, what people normally do. And when you go to look at the competition, a quantum level better than them as well. Um, you have to have decent traction relative to what you're looking to raise, right? That'll give you the traction will give you at the very least, it'll tell you a product market fit. If you're further along, you're going to want to tell me things about like your sales process, so I know that that's actually starting to click and get efficient. Right, so your traction slide has to carry its water as well. Uh, your team slide has to show why you guys are the right team to do it versus everybody else. Your go-to-market has to be as original and interesting and an advantage and well thought out as the product itself, and so on and so forth, right? So every single one of those chains has to work. If any one of those chains is broken and irredeemably broken, it's not like I can kind of I figured out how to fix it. Um, you're not gonna raise. Right? So that's how I think about it. Right? You got the overarching why now, and then if there is a good reason for that, I'll go chain by chain, link by link in the chain to make sure it still works. Now, I've been doing this long enough, and to go back to what we said about patterns, right? Different startups, different revenue models, different business models are more likely to have a weak link somewhere versus others, right? So the further away you are from that why now opportunity, the more closely I'm going to look at the competition slide. If you're selling to brokers, I want to know your total addressable market and your revenue model, right? Because let's take a very simple example. There's like a couple 100,000 commercial brokers out there, right?
Right. Yeah.
So if you're selling to a commercial broker on a subscription model, and it's $100 a year, and let's say there's 300,000, I think it's a little fewer than that, but it's 300,000 commercial brokers. I can do math, right? 300,000, that's a $30 million market. Tiny, right? I need $1 billion market. So depending on what model it is, I may look to different chain links in the chain first, and because I know where there's more likely to be a weak link. And then at that point, I can stop. I don't have to go through the rest of the chains if I found a weak link. So that's more efficient for me time-wise. So why now? Go to where I think the weak links might be first, then make sure all the other links are still strong if the weak links are good. And then I'm interested enough to dig deeper.
This is amazing. This is, we've been talking to a lot of people, and nobody has broken it down quite like you have. So I really appreciate it.
I'm happy to be, helpful.
Yeah, this is great. Um, I guess the last question maybe is, what are some of the most interesting things that you've seen, that you're either pitched or, we could talk about what do you see in the future, but that's just pure speculation for everybody,
Yeah,
anybody, but
sure. So I'm going to go a little bit into the construction space because that's one of them that's top of mind right now. There's a company coming out or in the middle of a program in Israel called Reach Israel. They're affiliated with Second Century Ventures, which, since you're in the brokerage world, you know very well. They're the VC arm of the National Association of Realtors. They've got they have 7 programs, 2 in the US, commercial and residential are separate. They've got Canada, Latin America, the UK, Australia, and now Israel. One of the companies in there is called LeanCon, Leancon, Lean Construction. The interesting thing they do is they will take the BIM, the building information model that an architect drafts, and normally that would then go to the GC, and they would come up with an 18-month plan for actually building, that building. These guys have an AI solution that will take that plan and auto-magically generate that plus or minus 18-month construction plan, which, if it works, is pretty damn awesome. They got 2 pilots right now. It's early, like they're still figuring out like how well it works. It seems to be working reasonably well. It's going to be a long road for them. I mean, again, this is kind of a critical point in the process. So you got people who are probably going to be, pretty like the bar has to be high to make it work. But actually, to touch back on one of the other points we made, one of the intros that I made for them was to Beck Construction. They are a design build shop. So since they have both the architects and the GCs in house, they would be more able to, appreciate how you can make that leap. Like the architects might be great. I'll use this and I'll sell like a value added service. But then when they turn that over to the GC will be like, I don't trust any of that.
right.
I need to do it myself. But, if you have one that's both design build, they might be in a place where they can evaluate the merits of something like that without there being he paid, but I benefit, or vice versa. He paid, I lose,
Right.
type dynamic. So like, that's really cool. Right. And at the higher level, like the why now for all of these things is, or a lot of these things is AI, right? AI can bona fide do a lot of things that just weren't possible 2, 3, 5 years ago. And AI has been around for a long time, but the kind of anyone can build their own AI, that's relatively new. So it checks the box on a why now.
Yeah, that's amazing. Well, let's see. I'm gonna wrap it here, but I do want to talk to you afterwards. A little
Sure, I
bit,
got a few minutes afterwards if
a
you'd
couple
like
of
to.
things. This has been so great. I appreciate it. If somebody is interested in getting in touch with you, pitching you the next best why now or something in prop tech or construction tech, what would you say is the best way to get
Best
in
way
touch
is
with
to
you?
email me, Ackerman, Ackerman, at SCV for Second Century Ventures .vc. Best thing for them to do is, heard the stash dash name of the company, right? Startup XYZ, right? And then they can start with, hey, I saw you on the stash. You gave the email address. My company does. Give me 2, 3 sentences because I have a very short attention span.
You and
My
me
company,
both.
my company does. It's your elevator pitch, right? So give me the 2 sentences on what you do, maybe even one. Drop some traction in there, so I don't see that. I'll assume you have none, right? We do XYZ. We're already doing, 20K MRR selling to clients like name drop. And then you can add in, and we're looking to raise, $2 million to get to target ARR by target date. And you
Mhm.
put it in there, it's nice, tight, it's a good pitch. If you want to attach your deck, that's great. It saves me from like having to look for it. If you want to send me a doc send, that's fine. I prefer it if you let me download it. I don't have to like click that link every time.
Yeah.
But yeah, that's how you can reach me.
Awesome. This has been great. Andrew, thank you so much. And, I hope you have a great rest of your day.
Thank you to you as well.